Hello, everyone. I hope you're doing exceptionally well. Welcome back to the channel. We have seen quite a bit of growth. I think we have doubled our subscriber base since the last time I recorded a video. You do these in batches and then push a bunch out at a time. Anyway, I really appreciate all the discussion, the comments, and please keep it coming. Like I always mention, I am not a financial planner, a financial advisor. I am just an infinite banking enthusiast, I guess, as I heard by one of the comments, and I think that's a great way of putting it. I practice IBC myself, and I am trying to essentially demystify the process. Uh, as a parent, one of the kind of questions I've been asking myself is, can infinite banking be used as an RESP replacement? Now, the title of this and the thought is a little disingenuous because remember, the infinite banking process is just a system of how to manage your money, and the product, which is a probably structured whole life insurance policy, is simply the tool. But can you incorporate the savings for the RESP and for your child's education through the infinite banking process? Now, to kind of give everyone a little bit of a Okay, so to give everyone a understanding of how the process works, has a very, very quick and simplified version. Essentially, the way this works is you produce an income with the IBC process. You funnel your money into your IBC process, which continually has compounded growth. And then you pull out your money via the form of policy loans. And then, of course, as a good banker with your income, you then look at paying back these loans, and you create this cycle where you essentially take loans, pay back loans, and because of the way money works and how money moves overall, because you're constantly generating a return on this end, you'll actually achieve better results. Anyway, I have other videos on the concept here. However, when you compare this to an RESP works obviously quite a bit different. So, an RESP essentially, how it functions is you, just like any regular investment account, you invest money into it. The government gives you some money, which is equal to your kind of overall contributions. And in theory, you are able to create a greater return because the government is giving you free cash. Now, typically, to maximize the government contributions, you have to contribute $2,500 per year. And ultimately, at the end of the 17, 18-year period, and obviously potentially for much longer than that, depending on when and if your child goes to school, you can contribute. Now, the maximum contribution to max out the grants is roughly $50,000. And once you get to this $50,000, you no longer get the government grant. What is good about an RESP is both the money you invest and the money that the government invests, both of these compound. And so, you are making money on someone else's money, and it's kind of like an RSP match or an employer matching program, right? That's a great way of putting it. Now, there's some negatives of the RESP model, and it mainly lies in what use the money can be used for. If your child goes to school, they are able to get both the money you invested, plus the government grants, plus the interest that is accumulated. If they don't go to school, then you lose components of this. And so, really, if your child doesn't go to school, there can be, I guess, negative consequences to this. Now, one thing we have to understand as it relates to the infinite banking process and system is that the idea is you want to create your own bank and have room. And so one of the foundations of when you're creating loans is not to look at them necessarily from an interest bearing perspective. And of course, they bear interest, of course. But as you use money, you are freeing up more space to store more money on a tax-free basis, essentially, right? And this is, primarily used when you're talking about investment properties and primarily investments. But let's say, for example, you go ahead and you've got a policy that's $100,000 cash surrender value. You go and borrow, say, $40,000 against it. Well, now you've got the $60,000 cash. The $40,000 is a policy loan that's outstanding. It bears interest, but the idea is now when you have a windfall of money or something along those lines, you can now park this money here and you now have additional tax-free cash to access and now use. This specific concept is more surrounding money that you don't necessarily intend to pay back, or money that you don't have a set time frame to pay back, I should say, because the idea is you always want to be a good banker. You always want to make your payments, right? So let's just compare the actual numbers behind this, because when I did this calculation, I was actually quite surprised at the outcome. Because when you are looking to park money in an infinite banking policy, you have to really compare it apples to apples. So with the RESP, you are contributing $2,500 a year. And so what I did is I said that somebody's going to park $2,500 a year inside of their infinite banking policy. So the exact same amounts of money are contributed. Now, let's just kind of get down to the numbers, and I hope you can see these on the screen. I really do. But essentially, I used a calculator that was provided. It made some assumptions, and the idea is that let's pretend you start this as soon as your child's born. They go to school when they turn 18. They go to school for 4 years. This was just the the annual education cost was just the default $7,300. Sure, whatever. It's largely irrelevant for the comparison I'm going to make. They assume a 4% rate of return. So one of the things with RESPs and really actually any type of investing that you do from a stock market perspective, and I'm actually going to take an aside here for a second. So, typically speaking, when you talk about risk and time, what ends up occurring, okay, is that usually the younger you are, the more risk you can take. And as you age, the risk that you want to take decreases. And usually, when you talk about planning, if you need money, within kind of a 5 to 6 year window, typically it's kind of in the cash slash CDs slash, GICs, all these types of things, very, very low risk bonds, that type of stuff, very low risk stuff that typically holds its value. Okay. Um, and that's kind of what you end up doing. And so really the growth years that um, a child would expect, especially if you're investing money for education, you need that money, you can't take risk with that money, is only really going to be kind of, that maybe 10 to say 14-year time frame, depending on when you actually start the overall RESP policy, or saving for your child's education, I should say. And so I don't think that a 4% rate of return is anything that is unrealistic for the purpose of an RESP. I think it's very possible that in the first few years, if you're invested in the market and assuming that an 8% average rate of return is actually something that is achievable, at the beginning years, you're going to be getting that 8%. And then over time, that's probably going to look more like 2% a year later on in the policies. Now, of course, your mileage may vary. You may have got better results. You may in the future get better results. Who knows? But of course, we all know that the stock market is relatively volatile, right? So we've got the $2,500 to max out. We said that there's no additional savings, no additional projected savings. We are simply going to be contributing the $2,500 a year. And the projected savings, according to this, are $77,602.52. Okay. We have far exceeded our education goals of the projected education costs at 43%, 43,000, and they've also assumed in this calculator that there is inflationary costs on the cost of education. Fine, okay, it's relatively irrelevant at this point. Okay, now one thing about this is $77,000 is certainly a lot of money compared to the whole life policy. So let's go over to the whole life policy. So, you have taken out a premium of about $2,500 a month. The required actual premium is about just shy of $1,200, which means the remaining $1,300 is what's known as an EDO. So it's basically your extra deposits that you make. This is what allows the cash value to be as high as it is. And what ends up happening, and I base this off of a 30-year-old male, by the way, just so everyone knows. So as you can see, your money starts to grow. And at the age of 18, which is when I've put the last payment to be made, there is $59,000 available inside of the account. Okay, so at face value, when you look at the $59,000 versus the 77, there's about an $18,000 difference, give or take, right? $18,000 difference between the two, and one would think that is fairly substantial, and I don't necessarily disagree with that. It certainly is the case. Um, However, let's think about this. If, and there's a big if, um, your child doesn't go to school, you lose a lot of the money that's in the projected savings account. Okay. On this side here, on the whole life side, this is your money to use. All right. Your money continues to grow. And so we assume that they go to school at 18. So 18, 19, 20, 21. They start here. So I guess 1 full year, 2 full years, 3, 4. Okay. So they graduate right here. Okay. They've got $69,000. So now the discrepancy is not so high. The discrepancy is $8,000. And then you go, okay, wait a second. This policy is going to continue to grow. The next year, the policy has risen. Okay, so here's where I have personally decided to switch all of my RESP savings over to the infinite banking. All right, so the main part is that if the true cost of education is this $43,000, by giving your child the $43,000, which you were going to do over here anyway, so it's apples to apples, right? You have now created an additional tax-free vehicle, or essentially tax-free, I should say, to store an additional $43,000. All right, that's one thing. I think from a child, uh, um, I'll say education moment, uh, the aspect of having to work for your education, and you can tell your child, listen, you've got to pay this back. You have to pay this back, and you've got to pay me back at whatever interest rate needs to be paid back at, right? It is what it is. You can set it, and you can start introducing your child to the infinite banking process. This policy continues to grow, of course, which means that the amount of money that you have continues to grow, even though this $43,000 is outstanding. On this side, the money's spent, it's gone, it's not going to produce any amount of return. If there is a stock market crash, it's very possible that this money will not be there. You know, if there's a 30% crash right before, you start reducing your risk, you could absolutely decimate the amount of money that's in here. With a whole life policy, as we know, the rates of return have been fairly consistent for a very, very, very long time. And it's a lot more unlikely that they're going to actually change anything that's about this. The rate of return in this policy is approximately 3.7%. I believe it's lower because the premium is lower. And so we set up a new policy personally, and this is just what I personally did. When we set up our new policy, we actually included the money that we were going to be putting aside for the RESP. I keep saying RESP, but for the savings for my child, into a larger policy, which actually produces about a 4.2% return. And, the difference might not seem like a lot, but the difference of roughly speaking, the 0.5% difference over the time actually makes these numbers so close together. It isn't even funny. Okay. And then you start to wonder, what is the point of doing what's the point, right? If you're going to almost you would theoretically, at least at a 4% average rate of return, you would beat it in the whole life. What is the point of doing the RESP when you have all of the benefits of the infinite banking policy? Okay. Now let's talk about the $43,000. So this was an Equitable Life illustration. Their current policy loan interest rate is 6.2%. Now you would not want to actually borrow the money directly from the insurance company, because in Canada, at least, once your policy loans exceed the adjusted cost basis, they start being taxed, which means the money that you would pull out would theoretically be taxed. So while this is the interest rate for Equitable, you can go and get yourself a line of credit. You can go get yourself a loan from a bank with your policy secured as collateral. And I was actually introduced to Equitable Bank um, um, cash surrender lines of credit, thank you, by a commenter in the last video I uploaded, which is great. Thank you if you're watching. But their current prime rate is 2.45, and of course, this is going to be based on prime rate. Um, and then you add, 1.25%, and so you're roughly at, like, I think it's the 3.7%. I'm doing this math in my head. It could be wrong. Who knows? Okay, but the truth is that you'll notice that the money you make and the money that you spend is going to be identical. So you're not going to be eroding your policy. First of all, any money you throw on this is now going to allow your money to continue to grow without an issue. And if your child wants to contribute, then they certainly can do so. That's not an issue in any way, shape, or form in the sense of contributing to the whole life policy and paying back the bank. And if you're in a larger policy, well, you're going to have a leverage delta, which means you're literally going to be making money more so than just the policy off of the money that you already were saving for your child's education. And it's just going to continue to grow and compound past that point in excess of what you actually had. So I hope that makes sense. It is not flashy. It is not mind-blowingly different at the end of the day. There are certainly some cons to the infinite banking side, where if you don't make minimum payments and you are borrowing directly from a life insurance or interest rates increase, it's possible that you could start eroding the policy. But again, you need to be an honest banker and you need to plan these things ahead of time. The worst case scenario, just like the RESP, is that you just pull your money out, collapse the policy, and you're good to go. Like, that's it, right? And so there really isn't a significantly higher negative than the existing RESP platform. Okay. So I believe, in my humble opinion, that there's only things to gain. Anyway, I would love to hear your thoughts on this and have a discussion. Again, I don't claim to know everything, and I try to film these in, 10, 15, 20 minutes, but this is a combination of hours and hours and hours of research and comparison and thinking things out. And of course, I'm going to forget things. And the comments that you guys put in are absolutely phenomenal. And you talk about things that I never even thought of. So I look forward to the discussion. Please like the video, subscribe to the channel if you're interested in hearing more about infinite banking and just, finances in general, thinking outside of the box. Anyway, enjoy the rest of your day. Bye.